All right. Well, what is up, tycoons? What's up, traders? Super excited for today's video. Gonna give you guys another TLT update. I know it's been a minute since I did one. I've been moving, and then actually just yesterday I got out the hospital. I got diagnosed with Bell's palsy. So basically, half my face is like paralyzed right now. It's pretty weird. But we're gonna get into it. Okay. So billionaire investor Leon Cooperman sees a self-induced market crisis and a stock picker's market. Here's what he's buying. Okay. And in Cooperman's opinion, investors are now in a stock picker's environment, especially if the S&P 500 turns out to be very pedestrian. He believes that we've seen the fat years and that now we're headed for several lean years, adding that the S&P's all-time high near 4,800 is probably going to remain the top for quite a while. The US is going through a textbook financial crisis, and that means investors should expect sluggish returns for in the S&P 500 for a long time, according to billionaire investor Leon Cooperman. All right, now this kind of lines up with a lot of the charts that I've been showing you guys. Right now, I'm not trying to be just a bear. Okay, I definitely trade to the upside as well, and I want the stock market to be bullish. But I have to keep in mind some of the possible scenarios. And if we take a look here, this is the SPX weekly chart compared to the Wyckoff method, and this is the Wyckoff right here, and we've been in the markdown phase where we got spring, we got the breakdown, and we got distribution. Okay, so you can see it's lining up almost identically. And then we got the throwback where we broke above this breakdown level right here, similar to right over here. And we got a sharp move down and we started putting in higher highs and higher lows over here, right? And we're in the correction phase right now. And if we end up taking out the lows, all right around 3,600, there's a very good chance we could head into the redistribution phase, which would take the S&P 500 to 3,400 to about 3,000. Now, this doesn't have to happen. Okay, we could try to continue making higher highs and invalidate, but currently it's still following the formation. Now, something really interesting is our weekly MACD is starting to curl down right here. Okay, so it's going to be really interesting. Like, does it bounce off of this blue line right here and head back up and potentially give us, another long signal that we could be heading upwards? Or if this thing curls down, it could be a signal that we're going to start this redistribution or finish this correction and potentially head into the redistribution phase. Now, with that being said, we are bouncing off of this bullish divergence trend line. If you're not familiar with bullish divergence, I'll explain it real quickly. Take a look how we have lower lows right here in the stock market. All right. But meanwhile, the relative strength index, our RSI, was making higher lows at these same exact points. So what we did was we were building relative strength, increasing, making higher lows, while the price of the stock market was going lower, creating lower lows. This is a term known as bullish divergence, and you can see here recently we just bounced off of that bullish divergence trend line again. Now, if we break this bullish divergence trend line and we get a MACD sell signal on the weekly chart, that could be, some more confirmation that this Wyckoff could potentially be playing out and could bring a lot of pain that people are not prepared for. Now, this is also the bump and run pattern that we have on the daily chart, okay? And you have your prevailing uptrend, then you have your bump and your run, all right? Basically, you run away from that prevailing uptrend and bump. And so here's the prevailing uptrend. Then we got our sharp bump in the beginning of the year. There's a very strong rally, and we've started to move down, and we broke our initial prevailing uptrend trend line. Now, it looks like we're kind of in this phase right here where we're, bouncing up a little bit. So it's going to be really interesting to see what happens. Does this continue to head up and do we potentially retest this trend line and break through? All right, that would be a look below and fail where sellers are presented the opportunity. Bears essentially have the opportunity to really push things lower with this bump and run pattern. But if they fail, then that's going to be a bullish signal, essentially that we could move back up higher to the 4,200 to 4,300 region. But otherwise, it appears that we're, in the up phase after breaking this prevailing trend line and could possibly be due for another leg down. Now we're going to go into the yield curves a little bit. If you take a look here, all right, we have the 10-year 3-month and the 10-year 2-year. This is the 3-month right here, and this is at historic lows, guys. This is the max chart, the all-time chart for this. Super, super low. Okay, we have the 10-year 2-month, or I'm sorry, the 10-year 2-year treasury yield, and it's starting to tick back up. Now, this is concerning, guys, and the reason is because an inversion of the curve typically signals a recession within 12 months, but the real risk starts when it re-steepens from the trough. And so what they mean is that you typically see the recessions, which are these gray shaded areas here. These happen after the yield curve uninverts, right? And so the yield curve uninverts here, yield curve uninverts here, yield curve uninverts here, and that's when you see these recessionary periods. Same thing over here, uninverts, over here, uninverts, then you get the recessions. And so the 10-year, 2-year is starting to tick back up. And, that's really when we're kind of due for a recession sometimes afterwards, according to the yield curve inversion indicator, which has been very, very reliable. Now, a lot of the essentially this Fed bailout is what they're calling it. Some people are. It's not necessarily a bailout, but they're just kind of guaranteeing depositors their money back after a lot of these bank crises. But this is not technically QE. Okay. So once again, bond and stock markets seem to be diverging with their messaging on growth, with bonds seemingly pricing a hard landing and stocks still choosing a soft landing outcome. Part of this divergence is based on the view we hear from many that the Fed backstop deposits equates to a form of QE, quantitative easing, and is therefore risk on for stocks. We disagree with that conclusion, we being Barclays, and think the focus should be on the more likely deterioration in growth due to the incrementally restrictive lending/credit environment that is now upon us. We also advise against the view that megacap tech is immune to these growth concerns. We recommend positioning in defensive low beta sectors and stocks. The pushback that they received for their forecast has consistently been that the hard data is holding up and companies are not seeing the slowdown you're forecasting. However, now we have the elusive catalyst that should lead to a convergence of the hard data with the soft data, and that is the yield curves, right? And the yield curve inversions. That's what they're speaking of. Now, TLT has been ranging, guys. It's been moving up and down, and you have to realize that there's been a huge liquidity crunch. All right. A lot of these banks, SVB or SBV, they had to sell a huge amount of treasuries, and they took nearly a $2 billion loss. So that's why you're seeing these crazy fluctuations and these crazy moves where it's shooting up and then you have huge red days and then it shoots back up. And it's been very confusing for a lot of traders. Okay. But, it's really just due to these massive liquidations that we're seeing, right? People and companies and banks, they're being forced to liquidate a lot of their treasury positions. And, it's causing these huge fluctuations. Okay. Especially when there's not a lot of liquidity in the bond market because the Fed has been doing quantitative tightening, right? Reducing the liquidity in the bond market. So, it's been a little confusing, but ultimately TLT has just been straight range bound, guys. We've tested this demand zone here about 3 times. We've tested this overhead supply zone about 3 times. So one of them is about to break. Now, something that we need to be cautious of is TLT has 3 gaps down to fill. We have one here right at 103. We have another one here at 100, and we have another one down here at 95. These gaps, guys, they tend to fill about 90% of the time historically. The big question is when they're going to fill. All right. So it's very important to just kind of keep track of them. If you take a look, there was a big gap in between the candles here, right? And this was back in February. And then now, a month later, we ended up filling that gap. So we have this gap down to fill. We have this gap down to fill. Okay. We also have this gap down to fill. And you can see just previously, the gaps right here, they filled. The gaps right here, they filled. Gaps right here, they filled. These gaps filled. So, that's why I'm showing you guys these gaps and, just advising that people be a little cautious. Now, something you can look for that's been a pretty useful tool on the daily chart for TLT has been the MACD. It's been very useful for spotting potential entries and exits. So if you take a look, when this blue line crosses over here, that would be signaled a buy signal. And you can see we got a very sharp move to the upside. And then when it crossed down below the other line, you can see we got a sharp move to the downside. Here again, we get another crossover to the upside, and you see a sharp move to the upside. We get a downside signal right here, sell signal, boom, and then a buy signal over here, boom. So, pay close attention to the MACD. It's been pretty useful. No indicator is going to be accurate and, work 100% of the time. But, for a good little while, the TLT daily MACD chart, MACD signal has been a very nice and useful indicator. So just keep in mind, guys, we've been range bound. It's been a really good traders environment. If you've been able to capitalize off of these, entry and exit signals. So, just stay patient. Okay. Wait for confirmation. don't have to force any trades right now, especially if you're uncertain, right? The bond market's a little bit confused because they're not sure, how to process all of these, bank failures, the bank crisis, and then also possibly the Fed starting to potentially ease rates because they're starting to break things in the system. Now, the markets in 2023 have been insane, right? So bank stocks have halted 10 plus times per day. The Swiss government is covering losses for UBS slash Credit Suisse. The FDIC is backstopping deposits on the collapsed SVB. Fed providing liquidity after years of quantitative easing. Regulators delisting slash auctioning banks. This is far from normal. Now, BlackRock warned Silicon Valley Bank last year that its risk controls were weak. BlackRock also flagged the people that worked in its treasury department, the same people who were responsible for billions in MTM losses for Silicon Valley Bank and its collapse. Federal authorities last week organized a move by major banks to deposit $30 billion into First Republic Bank to stave off a fourth bank failure. That came after the government promised to protect all Silicon Valley Bank depositors and announced measures to ensure that deposits at other institutions remain safe. Now, the Fed is initiating the largest liquidity injection since March of 2020. And, this is essentially the U.S. Federal Reserve total assets. And they basically put in $300 billion over the last week, guys. Meanwhile, they were negative $626 billion from April 2022 to the March 2023 low. And then all of a sudden, we got about half of that injected back in over the last week. So in my opinion, they're kind of just printing more money again, and inflation is super sticky, and inflation could come screaming back at us if we start to cut rates, and if we start to just doubt inflation. It's super sticky. 6 months from now, it could really, really come and cause a lot of pain and shock in the market. Now, the money being more money injected into the system means a weaker dollar and a crypto slash stock market rally. Bitcoin's been rallying. But be prepared though, because the correction after this will be drastic and sudden. So don't let FOMO grip your emotions right now. Keep working on your business, on your job, your career, and dollar cost average into the right categories of undervalued projects, stocks, assets that you believe in. All right. The Fed may provide as much as $2 trillion in liquidity relief for banks after the Silicon Valley Bank collapse. We're dealing with inflation right now, guys. And, a lot of this inflation, a lot of people say it's due to them printing so much money during COVID, right? And now they may provide as much as $2 trillion in liquidity. Again, not to repeat myself so much, but inflation could come back with a freaking vengeance, guys. And if we start to cut rates too soon, the market may start to, price that in, etc. And then all of a sudden inflation comes back with a vengeance. And now we have to start hiking rates again. And it's going to cause a big shock to the system. Now, these are the inflation expectations. And you can see here recently, inflation expectations have gone down a lot. And a lot of this is due to these bank crises, right? There's lots of talks that we could be heading into another financial crisis. And if that happens, you won't have to worry about inflation necessarily, because the banks won't even have no money, right? There won't be any money in the banks. So, it can go both ways right now. But I just want you guys to, just be open-minded, kind of be prepared for everything, and tread lightly during these times of uncertainty where things are not very clear at all. Now, we've got a shadow tightening of policy. Rates investors are worried that credit will be curtailed, which could be a drag on growth with disinflationary impulses. And so they would expect it to downplay the dot plot, citing heightened uncertainty about any path of monetary policy. Investors would be looking to gauge how the Fed is balancing financial stability risks against elevated inflation. One corollary of the volatility in banks is that lenders may tighten lending standards even further in order to protect themselves. So the repricing lower in CB rate expectations is understandable, yet too aggressive to us. First, we find fears of a global financial crisis overblown, as banking systems is a much better place now than pre-Great Financial Crisis. Now, we've heard stuff like this before, guys, and we're already seeing banks collapse, right? So, they're saying that the banking system is in a much better place now. How is this happening then? Right? How are we still getting these banks, these bank disasters currently if it's so much better, if it's such a better place? Classic indicators of stress like TED spreads or FRAOIS remain relatively orderly compared to past episodes, indicating the interbank liquidity system is still functioning. Now, banking crises are followed by tighter lending standards. And we mentioned that and mentioned credit, that credit would be curtailed a few times in this episode today. And here we can see that look at how high it is right now, guys. This is, March of 2023. This is COVID over here. And this is the great financial crisis. All right. We're way past that right now, much, much higher. So, just keep in mind that things could be a lot worse heading into the future. Yes, short term, we have been getting some good momentum, but that doesn't mean that necessarily we've priced in a bottom. So I'm not saying you shouldn't be invested in the market, that you should be uninvested, but you have to realize that, or at least have some realistic expectations that there could be a lot more pain, and you want to prepare for that the right way. Maybe hedge yourself, or speak with a financial advisor really, and try to figure out what's best for you. Of course, this is just a free video on YouTube, so I can't give you guys financial advice, but hopefully you enjoyed this video. That's pretty much going to be it. All right, we're going to wrap it up here. Smash that like button, subscribe to the channel if you guys are new, and I'm out.